exactly what is the best way to determine how much life insurance is necessary?
I like to have a full-fledged conversation with my client who's sitting in front of me for life insurance, because it's one of those areas that it's mostly misunderstood, and the people who buy it understand it. The people who don't buy it, which is a big chunk of persons out there, it's because they don't understand the need for life insurance. So as I sit with you today, I want to explore a couple of questions with you. What is the most important asset in your household?
Well, I think for me, my son and I, our lives are the most important. Then I would say my home, my house.
Right. Most people would say, "Oh, it's my house." They would say first, "It's my house," and I applaud you because the most important asset in your home is your ability to earn an income. Because if you don't have that ability to earn the income, then you're going to lose your home. You're going to be outside. And so your ability to earn an income is very, very important. And most people don't think about this. But when do you intend to die?
I wish I knew, but we don't.
And because we don't know when we're going to die, it's important that we plan. We plan for our auto insurance, that just in case we get into an accident on the street, wow, the person who we hit will get a chunk change, right? And their cars will be replaced and whatever. We also plan for our home because if the house burns down, we have an insurance policy that's going to replace it.
Mm-hmm.
And those two actions are just because, one, it's the law for you to have auto insurance, mandatory. And two, the bank says you have to have home insurance. And we don't do that with the most important asset in the world. The most important asset in your home is you and your ability to earn. And so I normally put this in front of my clients. I use various situations, but I like to use the one with the name of the ship is that sank back in 1914. What was that?
Oh, the Titanic.
Titanic. There you go. Right. So the Titanic, when it sunk, the iceberg that caused it to sink was below the water. They didn't see it. They were navigating against the iceberg on top of the water. So they could see it. Like you see your car insurance, you know why you need it. You see your home insurance, you know why you need it. So they were navigating against those and they ran into something that they didn't see. Just like you, son, runs into the fact that you die and he doesn't have you anymore.
Didn't see it coming.
Didn't see it coming. Neither you. All right? And so all we as insurance persons are doing is to get you to think a little bit more than just what you see. So we ask you, if you die tomorrow and your son survives you, how much is it going to take for him to live until he's 22 when he is out of school and out of college, right? It's first degree. And here we go. You make $80,000 a year. Half of that belongs to him because you spend that amount of money on him every year.
Or more.
Or more. Thank you. And so, but let's be conservative. And we say $40,000 a year for the next 6 years or the next 6 years. And then we jump in and say, okay, how much is college going to cost us? Another $40,000? So another 8 years, 10 years, that's $400,000 worth of life insurance.
So it's all about planning ahead in light of the fact that you have loved ones that you want to be able to be comfortable.
Yes.
And if education is a part of that,
yes,
then college planning definitely would be involved.
Yes, your expenses, you have a nice car, it's going to need to be paid off. Some people have homes that they believe they want to keep in their families. So they think the life insurance that I buy, I want to be able to pay off my home and give my son a place to live for the rest of his life. And other reasons are not evident out there, but once we sit down, we get a chance to roll through them as we ask you questions. So right now we're at $400,000 just with education.
Just with that, right?
All right.
Now, I've heard of whole life policies and I've heard of term policies. Can you give us an idea of the difference? Explain the difference between the two?
The word term implies that it's for a fixed period, right? Just the same, a term policy is for a fixed period. Whole life implies for your entire life. So that's a policy for your entire life. The difference on the whole life policy is there's a living benefit. And people don't take the chance to think about this. We have a living benefit and one that's a death benefit. The term policy is for death benefit. A whole life policy, living benefit, living and death. So you buy a whole life policy and it builds cash value. It's like a bank.
Mm-hmm.
So you're investing in yourself. You can take loans from it. Once there's money on the policy, you can take a loan from it and do whatever you want with it. Nobody asks any question because you're borrowing from yourself, right? So, but the whole life policy, once you buy it, the premium is fixed for the entire life, for your entire life. And your life is 121 years. That's according to insurance.
Oh,
right?
okay.
So 121 years. And then the term life policy, you could buy it in chunks of, in terms of 5 years, 10 years, 15 years, 20 or 30 years. Now, some people think that once the term ends, that you don't have a policy. You do have a policy. However, because now you are going to be rated at a higher age, insurance rates are quoted through morbidity and mortality, the ability to stay alive, pretty much, right? So if you are 25 today and tomorrow you're 40, the premium that the 40-year-old pays is a lot more than the person buying the same policy at age 20.
20, okay.
No, 25, right? And so we have to be cognizant of our age. My age, I am kind of off the map. So when I buy insurance, I expect to pay buku dollars on a whole life policy. And the same thing for the term policy. So, however, the insurance company, once you don't have that, once that term is done on the term policy, then the premium is much, much higher than when you actually started.
So when you purchase a term policy, you have, say, a maturity or an expiration date.
Expiration date.
And at that point, your monthly premium can change
Dramatically. Because, and that's why people think they don't have a policy. Because you were paying $20 a month, now you're paying $120 a month because the term is up. And so you don't keep that policy because you don't want to afford $120 a month for a term policy.
So what is typically the recommendation?
Recommendations, most companies have what is called conversion privilege, where between the first year and the 5th year of a term policy, you can convert it to a whole life policy, right? And you can convert pieces of it or all of it within that first 5 years.
Okay.
After that, you don't have that privilege anymore.
So another question, you talk about it being cheaper the younger you are, just based on age. But what of medical conditions? If I'm diabetic, for example, is it easy to get insurance?
2 people, 40 years old, walking inside of an insurance company and asking to purchase life insurance. One has diabetes, one has excellent health. One with excellent health is going to be rated at the lowest rate. Most insurance companies have different hierarchy of rates. And so if a person has diabetes, they may have a table 1 or a table 2 or a table 3, which is different from a 0 table. So you have 0 to 20 table. And depending on the type of diabetes you have, you may be eligible to buy insurance at another table, which is a higher rate, or you're not going to be able to. It depends. It all depends on a lot of factors. Whether and this is an underwriting question, but if they come out and do your labs and find that you're not taking your medication, if they decide to give you insurance, it's probably going to be much higher than if you are taking your medication. It all depends on what it is.